studying your last two. I swim med when I turned in. The staring down to mute. And can learn a pole that sunk he died.
Let's walk through exactly how a dividend eliminates a shareholder loan balance. Imagine that an owner-manager has withdrawn $85,000 from the corporation during the year. Those withdrawals were not recorded as salary and no dividends were declared at the time. As a result, the accounting records now show a shareholder loan account with a debit balance of $85,000. At year-end, the accountant needs to eliminate that balance. The first step is to determine whether the corporation has sufficient retained earnings or accumulated profits available for distribution. If the corporation has earned profits, those profits may be distributed to the shareholder in the form of a dividend. Next, the directors of the corporation formally approve and declare a dividend. This is often documented through a dividend resolution prepared as part of the year-end accounting process. Once the dividend has been declared, the accountant records the necessary journal entry. From an accounting perspective, retained earnings are reduced and the shareholder loan account is credited. In simple terms, the corporation is saying that the amount previously withdrawn by the shareholder will now be treated as a dividend rather than as money owed back to the company. No cash actually needs to change hands at this point. The shareholder already received the money during the year. What changes is the classification of that money. Before the adjustment, the books showed a shareholder loan balance of $85,000. After the dividend is applied, the shareholder loan balance becomes zero. The loan has effectively disappeared because it has been converted into dividend income. This is one of the most important concepts in shareholder loan planning. The dividend does not repay the loan with new cash. Instead, it reclassifies the existing balance. The money that was originally treated as a shareholder withdrawal is now treated as a distribution of corporate profits. From the accountant's perspective, this is often a simple and effective year-end adjustment that removes the shareholder loan balance from the books while properly reflecting the economic reality of what occurred. The key takeaway is that a dividend can eliminate a shareholder loan balance without requiring the shareholder to return any money to the corporation. The balance is cleared by converting the withdrawal into dividend income. Now let's look at the tax consequences that arise after a shareholder loan balance has been cleared using a dividend. One of the most important principles in tax planning is that eliminating a shareholder loan balance does not eliminate taxation. Instead, it changes the nature of the transaction. Before the adjustment, the amount existed as a shareholder loan balance. After the dividend is declared and applied, the loan balance disappears, but dividend income is created for the shareholder. Let's follow the flow. The corporation has accumulated profits available for distribution. The directors declare a dividend, and that dividend is allocated to the shareholder. Once the dividend has been declared, the corporation issues a T5 slip showing the amount of dividend income received by the shareholder. The shareholder must then report that dividend income on their personal income tax return. From the corporation's perspective, the tax treatment is quite different from salary. A salary payment is generally deductible to the corporation. However, dividends are not deductible. The corporation does not receive a corporate tax deduction simply because it distributed profits to its shareholders. The reason is that those profits have already been earned by the corporation and have already been included in the corporation's taxable income calculation. In other words, the corporation is distributing after-tax profits rather than creating a new deductible expense. From the shareholder's perspective, the dividend becomes personal income. The shareholder reports the dividend on their personal tax return and pays tax according to the dividend taxation rules. One important benefit is the dividend tax credit. Canada's tax system is designed to reduce the possibility of double taxation by providing a dividend tax credit that recognizes that corporate tax has already been paid on the underlying profits, even with the dividend tax credit. However, personal tax still applies. The shareholder cannot simply eliminate the loan balance without any tax consequences. This is why accountants often describe dividends as a reclassification rather than a tax elimination strategy. The shareholder loan disappears, which is beneficial because it removes a potentially problematic debit balance from the books. The year-end adjustment is usually straightforward and relatively easy to implement. However, the shareholder now has dividend income that must be reported and taxed personally. The key lesson from this slide is simple. Clearing a shareholder loan balance with a dividend solves one problem, but it creates a new tax result. The loan balance is eliminated, but dividend income takes its place. As tax professionals, we must always remember that removing a shareholder loan does not remove taxation. It simply changes the type of income that is being taxed. Now that we understand how dividends eliminate shareholder loan balances and the tax consequences that follow, the next question is why accountants so often choose this method in practice. The answer is that dividends are frequently one of the simplest and most efficient ways to clear a shareholder balance at year-end. One of the biggest advantages is that dividends are not subject to CPP contributions. Unlike salary, there is no requirement to calculate employer and employee CPP amounts. This can simplify the overall compensation strategy and reduce payroll-related costs. Another benefit is that dividends do not require payroll processing. There are no payroll calculations, no payroll remittances, and no ongoing payroll compliance requirements associated with the dividend itself. From an administrative perspective, dividends are often very straightforward. In many cases, the accountant can clear the shareholder loan balance with a dividend resolution and a relatively simple year-end journal entry. Dividends also avoid source deductions. There is no requirement to withhold income tax, employment insurance premiums, or other payroll deductions that would normally apply to salary payments. Because of these advantages, many owner-managed corporations find dividends to be an attractive way of dealing with shareholder loan balances. However, there are important factors to consider before automatically choosing the dividend route. First, dividends are not deductible to the corporation. Unlike salary, which generally reduces corporate taxable income, dividends are paid from after-tax corporate profits. Second, dividend income must be reported personally by the shareholder. While the dividend tax credit may help reduce the overall tax burden, personal tax still applies. Third, dividends are not always the most tax-efficient solution. Depending on the shareholder's income level, the corporation's tax position, retirement planning goals, and other circumstances, a salary may actually produce a better overall result. This is why experienced accountants do not simply ask whether a shareholder loan can be cleared. Instead, they ask which method creates the best combined outcome for both the corporation and the shareholder. A good decision framework begins with identifying the shareholder loan balance, then comparing dividend treatment against salary treatment, evaluating both corporate and personal tax consequences, and finally selecting the approach that best supports the client's overall tax planning objectives. The key takeaway is that dividends are often the easiest way to clear a shareholder loan balance. But simplicity alone should not drive the decision. The best choice is the one that balances administrative convenience, corporate tax considerations, personal tax consequences, cash flow needs, and long-term planning goals. For that reason, the decision between dividends and salary remains one of the most important tax planning discussions in owner-managed corporations.